Welcome to Chapter 5 of your journey through your 4-hour retirement blueprint in your 30s. In this episode, titled Invest Smarter, the 3-20-50 rule for 30-somethings, we'll break down a powerful asset allocation strategy that can help you maximize your investments while keeping your financial goals in sight. So, let's dive in and discover how you can make smarter choices for your future. Roughly 8 in 10 stock-picking funds trail a simple index over time. Yet many 30-somethings still agonize over dozens of choices. You're not failing at investing. The menu is broken. Today, we'll explore how owning just a few funds can quietly beat most of that complexity. Roughly 8 in 10 stock-picking funds trail a simple index over time. Yet many 30-somethings still agonize over dozens of choices. You're not failing at investing. The menu is broken. Today, we'll explore how owning just a few funds can quietly beat most of that complexity. In your 30s, the real threat usually isn't bad picks. It's stalling out altogether. Endlessly comparing funds, second-guessing every move, or hoarding cash because nothing feels like the perfect choice. Meanwhile, the market keeps moving without you. The 3-20-50 rule is designed to break that stalemate. It gives you 3 guardrails: how many funds, how much safety, how much cost. So you can move from "I'll start later" to "this is good enough to run with." We'll connect this to your retirement number, your account choices, and a simple habit of rebalancing that keeps you on track even when markets and headlines get loud. Think of this as the middle expansion pack to your plan from earlier episodes. You already know your target, your retirement number, and which containers to use: 401k, IRA, etc. Now you're deciding what actually goes inside those containers. Many 30-somethings either chase hot themes, AI funds, trendy ETFs, or freeze up because every choice feels like it could be wrong. Neither helps you close the gap between where you are and that number. The 3-20-50 approach gives you a default portfolio you can set up once, then mainly adjust as your income, risk tolerance, and time horizon evolve. Here's how the 3-20-50 idea becomes a concrete portfolio instead of just a slogan. Start with the 3. For most 30-somethings, that typically means 1. A U.S. total stock market index fund. 2. An international stock index fund. 3. A high-quality bond index fund. That's it. Those first 2 are doing the heavy lifting toward your retirement number. The third is there to keep you from getting knocked off course when markets throw tantrums. A U.S. total market fund usually holds thousands of companies, from mega caps like Apple down to smaller firms, so you're not betting on a handful of winners. The international fund adds the 40% of global stocks that live outside the U.S., so your future doesn't depend on a single economy or currency. You're buying human progress, not just one country's story. Now the 20. If you're in your 30s, a common starting point is 80% stocks, 20% bonds across those 3 funds. Within the stock side, many people split something like 60% U.S., 40% international, but a 70-30 or 80-20 mix is also reasonable. The exact ratio matters less than picking one and sticking with it. The point of that 20% in bonds is not to juice returns. It's to blunt the worst crashes so you don't abandon the plan right when patience would have paid the most. Then the 50. You want each fund's expense ratio comfortably below 0.50%, ideally closer to 0.10 to 0.20%. When you're scanning options in your 401k or IRA, that single line, expense ratio, is one of the most predictive numbers you can look at. Lower costs don't guarantee better performance, but they tilt the odds in your favor without any extra effort from you. So how do you actually assemble this with real tickers? In many workplace plans, you'll see funds labeled Total U.S. Stock Index, Total International Stock Index, and Total Bond Market Index, often from providers like Vanguard, Fidelity, or Schwab. If your menu is limited, you can approximate. A broad S&P 500 index plus an extended market fund can stand in for a full US market, for example. Once the pieces are in place, your main job shifts from picking to maintaining, checking once or twice a year whether your percentages have drifted too far and nudging them back. Each rebalance is a tiny, quiet decision to keep your behavior aligned with your long-term math, instead of with last quarter's headlines. Think about two 35-year-olds, Maya and Luis, both saving for retirement. Maya spends weekends hunting for the next NVIDIA and rotates in and out of sector ETFs. Luis quietly picks broad US, international, and bond funds with low costs and lets them run. Fast forward 15 years. Even if Maya nails a few big winners, the drag from higher fees, trading costs, and occasional panic sells can leave her trailing Luis, who simply stayed put. Here's where it gets interesting. Luis doesn't need perfect timing to benefit from downturns. When stocks fall and bonds hold up, his percentages shift. A once-a-year check nudges money from what held its value into what got cheaper. It's a built-in discipline that uses volatility rather than fearing it. Your mix can flex with life, too. Get a stable career, maybe you're comfortable nudging stocks a bit higher. Expect a big expense in 5 years, you might add a touch more bonds. The structure stays simple, the dial moves with you. As tools get smarter, the edge won't be secret strategies, it'll be sticking with a boring, resilient setup while others chase trends. Think of new platforms as better weather forecasts. They won't stop storms, but they'll help you pack the right gear and avoid the worst paths. In your 30s, locking in low costs and broad exposure now means each future pay raise can funnel straight into an engine that's already running, instead of constantly rebuilding the machine from scratch. Think of this as a draft, not a verdict. As your income, family, or risk tolerance shifts, you can tweak percentages the way a chef adjusts seasoning. Small changes, same recipe. The win isn't predicting the best fund. It's letting time, contributions, and discipline do the heavy lifting while you focus on building the life this money is meant to support. Before next week, ask yourself, 1. If I actually applied the 3-20-50 rule to my last paycheck, how much would 3% be for fun now, 20% for investing, and 50% for must-pay bills, and what would I specifically cut or shift this month to make those numbers real? 2. Looking at the 20% investing bucket, which account could I increase today, 401k, Roth IRA, or taxable brokerage, and what automatic transfer, down to the dollar and date, am I willing to set up before I go to bed tonight? 3. If my 50% essentials bucket is already overstuffed, which 1 to 2 fixed expenses, like rent, car, subscriptions, could I renegotiate, downsize, or replace in the next 30 days so that a future version of me can actually hit the 3-20-50 target without feeling constantly squeezed? This was Owl Up, your daily step forward. This series continues with more chapters on owlup.co. Visit owlup.co to access the complete course and continue your learning journey. See you there!